Ahoy there, traders, and welcome, welcome, welcome. Welcome one, welcome all. Another week's gone by. How are we all doing? Pop a little yoo-hoo in the chat box. Excellent, excellent. Hello, Anthony. Got all the old regulars. We've got Adrian, Andrew, Anthony, of course. Gira, Glenn. Hello, Kevin, Lee, Loy, Steve, Vito. Nice tiny group of traders this week. Maybe because it's a long weekend, holiday weekend in most places around the world, from what I can gather. Right, so we are recording. This will be ready over the weekend at some point if you have to dive off. But nonetheless, we're going to be looking at positive expectancy, risk rewards, and win rates. Whew, it's a bit of a mouthful. Positive expectancy strategies, which is a fancy way of saying, does it make money? So if this is new, there's one or two new names in the room that you see just popping in right now. Typical format for these sessions is we spend about 20-30 minutes and up to about 60 minutes talking about, well, this week's theme is positive expectancy trading. We're going to take a little look at the markets. We're going to try and find some trades to trade later on. And essentially review all the stocks that we're looking at for the moment. So if you are new, my name's Phil Newton. I am not a Wall Street guru. I am someone who has figured things out to the point where it's someone to replicate, and that's what I'll be looking at and hopefully illustrating to you later on. I'm just a regular guy who figured a few things out, and I want to help you see your own success. The backstory is been trading full-time since 2001, hand-drawing charts since the early 90s, calling most of my trades out in real time since 2004. I've had a few million with assets under management for various clients and private funds. I've coached thousands of students with my programs all around the world, personally mentored around 700, well, we're touching 560 now since I actually typed this up, but nonetheless, coached and mentored personally quite a few people over the years and decades now, from retail traders all the way through to banks, hedge funds, institutions, as well as the little guys like you and me. And I probably enjoy helping the little guy get one over on Wall Street more than helping Wall Street get one over on everyone else. Nonetheless, we're going to be looking at risk, reward, and win rate. The win rates, it's a bit of a tongue twister, but nonetheless, we'll get there in the end. So what's this all about? We're going to be looking at not necessarily how to test an idea. There's no right or wrong way. But ultimately, what we want to look at is when you've got an idea in trading, and I'm in complete strategy development mode at the moment. I'm really validating all my ideas, all my trading philosophies, mainly because I've found a coder. I'm not a coder. I'm not someone who can sit there and program things. I've done everything the hard way in that I go through everything, years of data, painstakingly, one trade at a time. It's just thing I have to accept. Like I've just got no interest in learning how to code things. So when you find a tool that can help you with these things, you want to seize the day. So that's what I'm in at the moment. I've been in this mode for about 18 months, and the fruits of my labor are what you're going to benefit from. So how do you get trade confidence is one of the angles to this. We all have our confidence knocked from time to time. I had mine knocked this time last year, probably like the rest of the world. The actual sell-off, the stock market crash, I was completely expecting. I didn't expect it in the magnitude that it happened. What caught me on the wrong foot was the V-shaped recovery again, just like this similar thing, just like the rest of the professional world. This V-shaped recovery really caught everyone on the back foot. It's never happened before. It's not happened so fast. If you go back and look at all the crashes through history, even the most recent one, the 2008 crash, it took 4 years to get back up to the highs. If you look at NASDAQ, the dot-com crash in 2001, it took 13 years to get a new high. So the fact that we saw a new highs, new all-time highs in, 4 months? It was unprecedented. So the point is, it kind of knocked everyone's confidence. It's certainly not mine. I've documented this. I'm very open about what I do and how I do it. And you get to see everything, warts and all. So How do you get your trade confidence? Again, if you've had it knocked, the first point of call is like, is there anything wrong with the strategy? And what it's allowed me to do is to further refine the production line. I've been talking about this for years, so it's not a new concept. But one of the elements to having confidence is to know what you're looking for, to have absolute crystal clear clarity on everything that you're doing. And if you ever are in a situation where you don't know what to do next, then, ask that question, what should you be doing next? So what I end up with is this mechanical scan to help me find, filter, and sort the best opportunities. We're going to be focusing on this for most of today's session. Then we want visual confirmation. Does it look like the picture that we're expecting? We use model frameworks to help, like, does it look like I'm expecting? If it's a buy the dip opportunity or trend trading, does it look like the picture? Does it look like it's straight out of a textbook? Your perfect example of what you're looking for. And this could be true with any strategy. If you buy the dip, sell the rally, buy range lows, sell range highs. If you're a range trader, buy breakouts. I spent many years just trading breakouts. So does it look like the picture? You want to visually confirm that what you're seeing is what you expect to see. Just because it's mechanically scanned up, it doesn't mean it's an automatic trading opportunity. We want to validate and confirm it with that human element. Now, even if you don't do that, as we'll see in a moment, we can probably get about 90% of the way there with any strategy and still be profitable. And that's what I'll show you later. We can be more profitable if we add this last element in. And then the final step to my overall production line is we want a profitable trade framework, or that's just a fancy way of saying money management. We want to know when we're getting in, when we're getting out if it's not working, when we're getting out if it is working, our targets, and what if it's taken too long? So it's going to either go to target, it's going to time out, or we're going to exit out on a stop loss. So there's only three things: up, down, sideways. It does what we want it to do, it doesn't do what we want it to do, or it takes too long to do what we're expecting it to do. And they're the three things. So they're the money management rules that we apply. And you should be able to apply most strategies, most philosophies into this framework. And some people do the visual elements. I can't let go of the automation elements, just because some things do flag up that just don't make sense. Mechanically they check the boxes, but visually they look like a bag of nails. So I've got to have that element in. But as we'll see in a moment, you could just sail through it. So what's the purpose of this? It's to have a repeatable process. One of the things that keeps me sane with trading is to be able to place the same trade tomorrow on any stock, on any setup, because anyone can get lucky with one trade. Anyone can get lucky with that lottery ticket type trade. And we've seen several of them. They've been in the news a lot. The GameStops, the AMCs, even Bitcoin. It's a bit of a lottery ticket. We can get lucky, short-term lucky. I would rather be long-term profitable with a consistent, predictable, repeatable business, because it is a business trading, than to get lucky on the lottery ticket of the pump and dump, the GameStop, the next AMC, the next insert thing, whether it's Beanie Bears, fidget spinners, whatever the thing is. I'm not interested in being lucky once. I want to repeat the success so that I've got another 27-year career after the current 27 years of been doing this. So that's more important to me. And it means that we can get the results that we're looking for. You can replicate it, which is the most important part. And why I do this is helping you see your successes in trading. So how do you get the trade confidence? It's to have a proven trading system. We also want to manage the risk so that we're not betting the farm. And you hear me say this every week. It's, manage risk, don't bet the farm. We want to trade small, trade really, really small, because it sounds counterintuitive, but then that allows us to trade frequently. And when I'm talking about trade frequently, I'm not talking about placing 20 trades for the sake of placing 20 trades. If your strategy sets up 20 trades, then you place 20 trades. But if you have none today, then you place none today. And that's what I mean by the frequency element. So we want to manage the risk. We want to trade small. It allows us to trade with the frequency that your strategy sets up. So that means that we're not cherry picking opportunities. I'm not going to place this trade because ... insert your bullshit reason, which is what we spoke about last week, inserting bullshit reasons to not place trades. You've got to be able to place the trade that's relative to you, your strategy, your situation. And frequency of the trade is just as important. So manage the risk. We trade small because that allows us to trade frequent. And I'm assuming that everyone's got a strategy. And if you've not, then obviously you can piggyback on mine. So before we get there, before we get to manage the risk, we want to test our trade idea. And we've already outlined the production line. I'm going to be focusing on, just walking you through some of my logic, what I'm looking for in the mechanical evaluation, the mechanical trading opportunity, because it helps me have faith in a system, because there's nothing worse than having a trade set up and then you ask the question, like, will this work? Is this going to work? Is this going to make me money? Am I going to lose money on this trade? All those crazy questions that we ask ourselves, like, is this going to work? Will it work? Won't it work? Is this the one? Am I doing the right thing? You place the trade, you have sleepless nights, sweaty palm, all the rest of it, all those things that go through our minds in a flash at every opportunity when we think about it. We want to eliminate those. So it comes back to, we need to test our trade ideas. So what am I looking for? So one of the strategies that I look for is to trade trends. So just to illustrate the look for, I want to try and find, this is a model example of one of the several scans that I look for. I used to refer to this as pattern number 4 because it was the fourth pattern that I researched that I really liked. And it's counterintuitive. This is an oscillator, this indicator here. And I'm using it in a non-standard way. I'm using it to find strong trends. So an oscillator is usually used in range trading and reversals, but we can use it for trend trading. I can use it to help find what could be strong trends, because the thing that's wrong with an oscillator like this is percentage R, it could be stochastics, it could be CCI, it could be RSI, it could be, insert the oscillator of your choice again. I just happen to be using percentage R. And the downside to oscillators is in strong trends, there's the phrase, in strong trends, oscillators will remain overbought or oversold for long periods of time. And that's the negative for using oscillators in as a reversal indication. Now, oscillators are great when markets are ranging, but can we take that negative and turn it into a positive? So can I use the fact that oscillators remain, in this case, overbought for long periods of time in strong trending opportunities? So if I combine this with my buy the dip methodology, we can see the 200-period moving average on the chart there. And we get the average prices have crossed over. There's the 50-period moving average. So if I combine the fact that I want to buy the dip in an uptrend, and we've looked at using moving averages in many past sessions, but then if I also layer on this logic to find not just a trending stock that has historical precedent for trending, but if I layer this on top of it and say, you know what, let's see if we can find the power trends, the super strong trends, power players inside of the stocks, because a stock that is overbought or oversold for long periods of time is potentially going to be a really strong trend. So the way that percentage R works, the R stands for range. A big surprise. And for this to stay in the overbought for a long period of time, all it's doing is saying, like, where is price in relation to the range? And you can look back over, 20, 30, 40, insert the time horizon that you want to assess. So for this to stay overbought in this case, it's got to be making new highs. It's got to stay in the top 20% of its rolling range. And for that to happen, it has to be trending regularly, has to be trending strongly. So if I can layer that onto everything that I like to look for, again, we've spent many sessions looking at this in the past, then I get a good trade idea. Pattern number 4, as it turns out. Pattern number 4. So what I'm looking for, again, just coming back, so we know where the end result, that's what I'm looking for. these types of indications, on top of all the other things that we've spoken about in past sessions, I want to see a steady equity curve. That's what this is. We can automate it and validate and test the idea. I've manually traded this for years, but I can now say, okay, as we looked at, which stocks are best for this strategy. I'm looking for stocks that are profitable, long and short, and on average greater than 40% of the time. And we'll see why this is important later, why that 40% is important. If you want to trade long only, because some people only want to trade long, and that's cool as well. I'm okay with that. There is a positive drift. There is a positive bias in the markets. So if you don't want to trade short, that's okay as well. So if that's your bag, then you want to make sure that at least 40% of the trades on the bullish side are also profitable. And the profit factor is, again, fancy way of saying, if I put $1,000 in, how much will I get out on average across all the trades? The more, the better. So it's realized risk versus realized reward, not theoretical. So your realized risk reward, it needs to be greater than 1.5. If I put $1,000 in, I want to get my money back and $500. So that's what 1.5 means. So I want to make sure that I've got a good return on my capital. Return on risk in this case. So that's what this is kind of like. That's what I'm looking for. Does that make sense? Let me just pop a comment in the chat box. That makes sense so far. That's what I'm looking for, the end result. Now, we're talking about in terms of validating strategies and ideas. So we're layering this extra bit on. Perfect. Thanks for all the thumbs up, folks. We're layering this extra bit onto trading the trend, the buying the dip, the using the moving averages, and then layering this extra criteria onto what we've been talking about for the past year. Then we can go and test the idea. Does that make sense? That's what we want to do. We want to test the idea. We want to test the idea. So quick example, Boeing. I think we looked at this last week. But Boeing, we want to make sure it fits the narrative. We want to make sure that it fits our criteria. And not only when the average prices are pointing up, we want to basically trade when prices above the 20-period moving average. But what we also want to make sure is we want to make sure that it's in that top 20% of its rolling range. So we're trying to capture those explosive parts of the trend as well, in addition to it's in a trend. So steady equity curve. Again, we're looking at Boeing. BA is the ticker symbol. So we've got a nice steady equity curve, a little bit of a blip back here, but nonetheless, this is over a 20-year period. You can just see the data there from 1999. This has produced great trading results. Again, it's not quite profitable on both sides. You can see there that the short trades, which is why I initially just ignored this. But if you just want to trade it long, it does produce great long trades. Now, even with the short trades don't work as good, there's only a small loss there. But nonetheless, taking all that into account, 1.84 is the profit factor. So what that means is if I put $1,000 in, I'll get $1,840 out. But if I take the short trades off the table and just trade the long trades, 2.87. So it's almost 3 to 1. So if I put $1,000 in, I should get $2,870 out on average in the last 20 years. Now, this is without compounding, So if I just put $1,000 in every time over the last 20 years, I'll get $2,870 back out. That's what that's telling me. So I'm not going to pretend to say that I did do that on every trade. I traded some of these, I didn't trade all of them. But what I'm able to do is to validate, yeah, this is a great idea, Phil. This gives me trade confidence. This gives me a proven process to follow. So it's not just a case of, well, Phil's a great trader. Phil's been doing this. Phil has some secret blend of herbs and spices that only he brings to the table. I've just proven, well, let's just go back. I've taken that part out, and we're just looking at, well, if I did nothing else but trade the mechanical part of the process, we should make money. So that when we add the visual components, when we add money management, because right now we're just looking at the worst version of any strategy is signal to signal. The worst version of any strategy is signal to signal. So that's what we're looking at here. This is the worst version of any strategy. It's signal to signal because there's no discretion involved. There's no coulda, woulda, shoulda, maybes. But it gives me the confidence to go, you know what? I'm probably going to have this stock in my universe. And that's what we're talking about. There's 28,000 stocks in just on the US stock markets. Most of them aren't worth trading. So what I'm trying to figure out is which ones are worth trading. Personally, I don't want to trade low float stocks. I want to trade liquid stocks that have options. I want a certain amount of liquidity so that I can get in and out whenever I want at any time that I want. I don't want to have to worry about the things that we saw with GameStop, where there was not enough trading activity to open and close positions. That was a major problem at the time because there just wasn't the liquidity there. And that was part of the issue that caused the pump and the dump and the subsequent pumps again. So I want to be able to not have those, because I want stable trending stock, good companies that have stood the test of time. That's what I want to trade, because I can profit from those swings in the markets. So that stability, that criteria alone, that gives me about 2,000 stocks. So straight away, the 28,000 stocks in the known trading universe, they come down to about 2,000. So of those 2,000, I can run these algorithms, these automations to say which of these stocks are the best for my preferred style of trading. So then when I apply the algorithm and I can say, okay, this is good, this isn't good, one of the things that I'm looking for, again, tied up with the risk and the reward and the win rates, wow, that's a tongue twister, is I'm able to say, okay, well, if I've got a certain amount of profitability, so there's that 40% number that we were just talking about. If I've got a certain amount of profitability, and then I've got at least 2-to-1 realized risk reward, not theoretical, not I want to make one, make 2 and risk 1. That's theoretical. I'm talking about realized risk versus realized reward, what actually came in and out of my pockets. So that's what we've just looked at. The actual strategy would have given you a realized risk reward of 2-to-1 about 40% of the time. So we know that that strategy is profitable. That's what it means. And then when we apply that secret blend of herbs and spices, the thing that you bring to the table, I'm going to eat the meal anyway. So this is the meal, to use a food metaphor. I'm going to eat the meal. This is a great stock. It's a great strategy. It's proven, it's time tested, it's data driven, it's validated. I've been trading it manually for decades anyway. But now it just gives me, yeah, this is extra confidence. So now let's try and find the best candidates, the best opportunities to trade this strategy. I want to eliminate the stocks that are just historical poor performers. For example, Pepsi. Pepsi, everyone's heard of the stock. It's a great company, but there's not much growth. There's not that much activity on the stock. It's pretty much a dead stock. It's almost like a utility. It doesn't go anywhere. It doesn't move anywhere. It's great for other strategies. And I've got a strategy that's great for stocks that just don't go anywhere, that don't move anywhere, that don't trend. So I need to exclude that stock out of this universe because it is actually not profitable. If we went and looked at the algorithm, I think it's about 27% of the time, you're not making any money. So we want to try and exclude the stocks that are not giving me the realized rewards, that are not giving me the profits. And generally the sweet spot is I want to see profitable trades about 40% of the time. And I want that profit factor to be about 2-to-1. Now, obviously the more the merrier, but that means that I should have this profitable trade zone of strategy with a profitable trade zone of profitable stocks with a profitable proven strategy. Ooh, that's more tongue twisters. Does that make sense, folks? So this is where the risk reward is. Now, I only know this from testing strategies, testing ideas. Manually, I want to check them first, and then I can just kind of spin it through the algorithm and say, like, is this a good performer? Is it a good strategy? And which stocks should I be focusing on? Do I want to trade on a Pepsi, which is pretty flat and has been for 5-6 years, despite all the nonsense that's going on? Or do I want to trade it on stocks that swing back and forth? I don't really care what the name of the company is. Like, for example, Weight Watchers, a stock that we spoke about last week. We're going to look at it in a moment. It's dull. It's boring. It's been going around for a long, long time. people always want to lose weight and diet and feel good and look good. So I would imagine it's going to be around in the future. So without even looking at the fundamentals, I've got a good stock that's historically proven, and it spits out great trades, great results. And it's a boring stock. It's not sexy. It's not exciting. It's not Tesla. Elon Musk is not driving Weight Watchers to the moon. I don't care. The whole objective of what we're trying to do is to find stocks that consistently move, that allow us to consistently profit. So if I plug in these parameters and go back one, I want to be able to find those stocks that have profitable trades, long and short, or just long, have a good profit factor, nice steady equity curve. That's going to give me the least headache. Again, remember, this is the worst version of any strategy, is signal to signal. So that when we apply money management, now bear in mind, this is these results are with stocks. So if I apply my preferred vehicle is options. So if I know that if this is realized risk to reward, so if I risk $1,000 on stock, I should be able to get 2,000 out. That's what this is saying. It's profitable, and it's profitable 40% of the time. So if that's my sweet spot, as soon as with stock, as soon as I go to options, my return on risk goes exponential because my risk is with an option. My return on, so we're talking about the return on the risk here. So, you know, the 2-to-1 risk rewards on the stock starts to get magnified just because I changed the vehicle that I use. It goes from 2-to-1 risk rewards, and maybe it skips to, 5-to-1. Maybe it skips to 10-to-1. It becomes a 10 bagger because I can do some creative strategies with a stock option. So this suddenly goes exponential from 2-to-1, maybe it jumps to 5-to-1 just because I use an option instead of stock. So let's take a few examples. Adrian, I'll answer your question in a moment. We'll actually go and put that through the algorithm. So we want to have data-driven decisions. So again, here's Weight Watchers. It's a nice, steady equity curve. It's profitable since 2001, quite regularly in the last 20 years. It means it's going to be in my universe. Similarly with Starbucks. Now, what you can see in the background, and we've looked at this from the classical trend trader, we can buy the dip in the classical sense. But then when we start to layer on what I usually refer to as the range rider, it's just looking to ride the range higher. As long as it stays in that top 20% of the rolling range, we should be able to capture some extra opportunities. We can start to think about, well, if I apply what I know about money management and say, okay, well, historically, this is a stock that's 50% of the time produces great results in bullish and bearish moves, then maybe I can increase my position size when price is in an uptrend classically, and then it goes in that top 20% of its rolling range. Maybe I can maybe I can increase my position size to try and magnify my profit potential, because the money management elements is the thing that's not factored in here. This is non-compounded. So I can start to apply the just basic compounding principles and compound into a proven data-driven stock that has a tendency to trend strongly. That's what we're able to do. Similarly with AMD, if you want to trade the tech stocks, again, it's not just boring Starbucks, Weight Watchers. It will work on tech stocks. Again, we've got a good historical performance since 1999. Similarly with UIS, again, we've got a nice steady equity curve. I'm sure we can all get the idea. We're looking for steady, regular, consistent returns. This is Netflix. Netflix has provided some great opportunities. And this is a good example of that visual components. The trades, as you can see there, a little bit of a downtick in the equity, but it takes into account the trading during this period. Now, what we've been doing and what we talk about is that, well, visually, I can say that probably about here, I can recognize, what, I've got in about the last 3 months there, prices, it's confirmed as being in a range. You've got that 1, 2, 3 touch points that we always talk about to say, okay, well, we're probably in a range. So maybe I can just not worry about trying to buy the dip because we've got a very short-term consolidation. We can start to apply the ranging strategies and avoid those downturns in the just trading it mechanically. And that's kind of the element that I was talking about before. That's that visual confirmation. When you recognize the trend, like actually it's either going up, down, or sideways, it means that we can start to override the decisions. And again, we've got rules for all of these things to mechanize the decision-making process. There's very little guesswork involved, but that's the only thing that can't be coded: when to switch the trending off and to start applying a different strategy or a different money management technique so that you can maximize the opportunities. Again, that's what the visual confirmation is for. Are we trending? Are we actually trending? Where's Netflix? There we go. So are we actually trending, or are we actually ranging? So we get 1, 2, 3 peaks, 1, 2, 3 troughs, 1, 2, 3. There we go. So again, around about that point, that's where you would have said, you know what? Although the trending strategy is saying buy the dip, let's not worry about buying the dip. It's in a range. So I can start to say, well, where we're at range lows or we're at range highs, we can start to apply ranging strategy. This is one of our 6 trends that we talk about. Again, it's either going up, down, or sideways. So one of them is buy the dip. The other one is we're in a range. We can buy range lows, sell range highs, or wait for the breakouts. So again, we've got choices. So it helps us to avoid that whipsaw price action because it's visually in a consolidation. Again, that's the thing that we can't code. That's going to help you avoid that little downturn in the equity curve, and that's going to increase your profitability. So that's the visual confirmation that I keep talking about. Again, a good example of what we mean by that. And ATI, this is again scanned up for me as I'm going through my annual, which stocks are good. We've got a lovely steady equity curve on, again, a boring stock. It's been going since 1999. We've got a nice steady equity curve. Profit factor is almost 2.26. So what I know is that this stock, ATI, I don't know if the next trade is going to be profitable, but based on historical data, historical no discretion trading, it's giving me this is and does have a historical tendency to put in strong trends. And that gives me confidence to place the next trade. It gives me confidence to go, you know what, this is probably the best stock or a better stock to trade than, say, Tesla or Pepsi. And we'll go and look at them. And it all starts with testing these ideas. So I'll just pose that question. Do you have trade confidence in what you're doing? And if you don't, then firstly, apply what you're doing to this model. Mechanical scan, visual confirmation, and then apply your money management, profitable trade framework, timeout, target, exit. They're the 3 stages that I talk about. They're the 3 stages that I follow and advocate. Apply a framework to your decision-making process. So if you've not got the trade confidence for your next trade, you've got to ask yourself why. And if you're asking yourself why, like, should I be trading this? Well, either you don't have confidence in the stock or you don't have confidence in the strategy, then you need to do more research. And then this is what we spoke about last week as well. Have a look at the research elements. For years, I manually tested a lot of things, a lot of trade ideas, and it is well worth it. I'm not suggesting that you have to go out and hire a programmer or a coder to go and do all this for you. You can just go back through and manually test your trade ideas. A lot of these ideas for me, they started in the currency world. I was 12 years a currency trader. A lot of these trade ideas started out there. And some of the ideas that we use today, they just don't work on currencies because currencies behave a little bit differently. They're more prone to ranging and breakout type of strategies. Whereas with stocks and stock options, we've got a variety of different choices. And you can quite literally find a group of stocks that makes the most sense for you. And one of the things that I do, right now, I'm trying to curate my top 50. I want a slower pace in my trading. So I'm trying to create my top 50 stocks, and that's going to be my focus and is my focus. I've got about 35. I'm just kind of switching in and out and finding the best stocks to kind of have in that top 50 so that I've got the confidence to know that I'm not missing anything. I don't care about the next year GameStop. I don't care about the next AMC because I've got my top 50 stocks that are proven historically. They're data driven. I've got a strategy that works on these stocks long term. So it gives me the confidence to go, you know what, the next trade is probably going to be a good one. And if it's not, my money management, my exit rules will take care of it. And maybe it's the one after. But I know that 40 to 50% of the time, if I'm not thinking about it, then my trades are going to be profitable. And when you've got a positive expectancy, when you know that historically you've got 2 to 1, 3 to 1, 4 to 1 historical expectation of realized risk to rewards, then it means that those profitable trades, you start to fall into the into kind of this zone of the time. Again, I didn't without manipulating the data, I think that's unrealistic personally, but you start to fall into this realm of like the group of stocks that we have should allow you to have the confidence, because they're falling into that zone of 40 to 50% of the time, I'm going to make 2 or 3 or 4 to 1 realized risk to reward. And that gives me the confidence to not worry about, hey, you know what? I don't care if GameStop is going to the moon today. It doesn't normally go to the moon. I don't worry about it. I'm not going to care about the pump and dump stocks. So that's what I would, advocate to you today, folks, is think about the risk reward. You can start to think about it. You can start to look at the, where are we? We can start to look at the stocks that are making consistent rewards for you, so that it's not a theoretical risk reward. You can look at the data, you can look at the trades ideas that you've been testing and say, you know what, where on the spectrum does this fall? Is it a profitable strategy that that you're following? Is it a profitable trade idea? And if you need some help with that, that's okay. Maybe you need some help. Maybe you're not sure what to do next. Maybe you don't know what you don't know. And if you do want some guidance with this, I do offer a swing trading mentorship program. And if you want some help with this, you can learn my full production line trading process in addition to all the algorithms that I give out. We're going to look at those right now in a bit more detail, but you'll be able to focus on the best stocks, the best patterns to trade, that's data driven. As you've seen, you don't have to take my word for it. The algorithm shows you, hey, these are good stocks, these are good strategies to trade without any human intervention. And this is what makes it replicatable. This is what means that you should be able to have the confidence to place the next trade, because Phil's placed the next trade and all his other students are placing the same or similar trades because it just works. Most importantly, you'll learn the trade management elements, the TTE, timeout, target out, exit out. As we've just illustrated, the real secret to any success is not the money that you make, it's the money you keep. And we do this usually with just by switching from stock to stock options and using what we call a stock replacement strategy, using options. It just means that it magnifies those numbers. Sometimes, 5, 8, even tenfold. You get the illustrious 10 bagger just by moving to stock options. You won't be zombie trading. You won't be flicking through chart after chart after chart. You won't be stressing over which way the markets are going, wondering what's going to happen next. I've spent a lot of time away from the desk in the last several weeks. I went to the zoo again yesterday, for example, took advantage of the wonderful UK weather that we have. I got an amazing photo of a tiger up close and personal as it was feeding. But hey, none of that would not be possible if I didn't have swing trading, and it allows me to not be glued to the screen, is the point that I'm trying to make. So if you want a little help with that, just go to Tony the Tiger. Absolutely, Tony. I'll send you the photo, actually. It's wonderful. Just very simply go to AntiVestor.com, watch the short 14-minute video. If it makes sense, let's talk. If it doesn't make sense, that's okay. At least you'll know what you're not looking for. And if you are looking for it and you do need some help, then by all means, send me a message and we'll take it from there. So risk and reward, folks. Risk, reward, win rate. It's not how much you risk. It's not how much you're making. It's not the win rate. It's all of these things together that make the start of a good strategy. It's not the be all and the end all, but ultimately it's a very important thing. A lot of people focus on how much your reward is, how much your risk is, and it's all theoretical bullshit. It really is. It kind of winds me up. I want a 2-to-1 risk reward ratio. I want to risk $1,000, so I'm going to make $2,000. Does your strategy actually give you that? That's what you're able to validate when you've got a trade idea, when you've got rules to follow. Just because the textbooks say you should have a 2-to-1 risk reward ratio, does your strategy actually give you 2-to-1 on the risk versus reward? Well, there we go. The textbooks say 2-to-1, and well, here we go. I can trade ATI, and on average, it gives me 2.26 to 1. There we go. So this is giving you a 2-to-1 risk reward, realized risk to reward ratio, and it's doing it about 50% of the time. That's pretty decent. I like those odds. It gives me confidence to place the trade. That's the point. But the textbooks people misinterpret that risk to reward, and they'll have so say they're entering on these crosshairs, they'll have the tightest stop loss so they can have the biggest position size, and then they'll go the 2-to-1 risk reward route. Well, the reality is you probably need a wider stop loss. Most people's stop losses, most people's risk management is just incorrect. So this is based on a wider, slightly wider than most people suggest stop loss. Again, and as soon as we go to stock options, all of these numbers get magnified, which is the awesome part about all of this. Anyway, I'm rambling. Positive expectancy, risk, reward, and win rates. It's not one, it's not the other. They're not separate. It's all a cohesive evaluation to determine like what's going to give you the best opportunity right now on the right stocks. And this is what I call and what I often refer to as a positive expectancy. As we've seen, you don't have to take my word for it. The data proves it. It's not just the strategy, it's also the right universe of stocks for us to work on. So with that said, let's go and find some awesome stocks to trade.